Dividend policy sits at the heart of a company's financial strategy, representing a delicate balance between rewarding shareholders and reinvesting in the business. It's a decision that can shape a company's future, influencing its growth trajectory, market perception, and shareholder satisfaction. At its core, dividend policy determines how a company allocates its profits. Does it return earnings to shareholders in the form of dividends, or does it retain those earnings to fuel future growth? This decision is far from simple, involving a complex interplay of financial considerations, market expectations, and strategic objectives. Companies must weigh the immediate gratification of dividend payments against the long-term potential of reinvested earnings. A generous dividend may please shareholders in the short term, but it could limit the company's ability to fund new projects or weather economic downturns. Conversely, retaining all earnings might fuel rapid growth, but risk alienating income-seeking investors. Numerous factors come into play when companies craft their dividend policies. Financial performance is paramount. A company must have sufficient earnings and cash flow to sustain dividend payments without jeopardizing its financial health. The company's growth stage also plays a crucial role. Young, high-growth companies often retain most of their earnings to fund expansion, while mature companies with stable cash flows may opt for higher dividend payouts. Market expectations exert significant influence as well. Once a company establishes a dividend, shareholders often expect it to be maintained or increased over time. Cutting dividends can send negative signals to the market, potentially triggering a sell-off. Legal and contractual obligations can also impact dividend policy. Some debt covenants may restrict dividend payments, while certain types of preferred stock may require regular dividend distributions. Tax considerations add another layer of complexity. In some jurisdictions, dividends may be taxed differently than capital gains, influencing both company and shareholder preferences. Dividends serve as a powerful communication tool, signaling a company's financial health and future prospects to the market. A stable or increasing dividend can convey confidence in future earnings, potentially boosting the company's stock price. Conversely, a dividend cut may be interpreted as a sign of financial distress, even if it's intended to preserve capital for future growth. This signaling effect underscores the importance of a carefully considered, consistent dividend policy. The percentage of earnings distributed as dividends is a key metric in dividend policy. A high payout ratio might appeal to income-focused investors, but could limit the company's financial flexibility. A low payout ratio, while potentially disappointing for some shareholders, leaves more capital available for reinvestment. There's no one-size-fits-all approach to payout ratios. Companies must find the right balance based on their specific circumstances, industry norms, and strategic objectives. Types of dividend policies. 1. Stable dividend policy, maintaining a consistent dividend regardless of earnings fluctuations. 2. Constant payout ratio, distributing a fixed percentage of earnings as dividends. 3. Residual dividend policy, paying dividends only after funding all profitable investment opportunities. 4. Progressive dividend policy, gradually increasing dividends over time. Each approach has its merits and drawbacks, and companies may shift between policies as their circumstances evolve. Retained earnings represent the portion of profits not distributed as dividends, instead reinvested in the business. This internal source of financing plays a crucial role in funding growth initiatives, from expanding operations to developing new products. Retained earnings offer several advantages over external financing. They're readily available, don't incur interest costs, and don't dilute ownership. However, excessive retention of earnings can lead to inefficient capital allocation if the company lacks profitable investment opportunities. Companies must carefully consider how to deploy retained earnings. Common reinvestment strategies include organic growth, expanding existing operations or entering new markets, research and development, investing in innovation to stay competitive, capital expenditures, upgrading equipment or facilities to improve efficiency, mergers and acquisitions, pursuing inorganic growth through strategic purchases, debt reduction, strengthening the balance sheet by paying down loans. The choice of reinvestment strategy should align with the company's overall strategic objectives and offer the potential for attractive returns. Share buybacks have emerged as a popular alternative to dividends, offering a flexible way to return capital to shareholders. When a company repurchases its own shares, it reduces the number of outstanding shares, potentially increasing earnings per share and stock price. Buybacks offer several advantages over dividends. They're more flexible, allowing companies to adjust the amount and timing based on available cash and market conditions. They can also be more tax efficient for shareholders, as capital gains are often taxed at lower rates than dividends. However, buybacks aren't without controversy. Critics argue they can be used to artificially boost stock prices or executive compensation tied to stock performance. There's also debate about whether buybacks come at the expense of productive investments in the business. Both dividends and share buybacks can significantly impact a company's stock price. Dividend announcements often trigger short-term price movements, with increases generally viewed positively and decreases negatively. In the long term, a consistent dividend policy can attract certain types of investors, potentially providing support for the stock price. However, excessively high dividends that limit growth potential could ultimately depress valuation. Buybacks, by reducing the supply of shares, can provide a boost to stock price. However, the market's reaction often depends on perceptions of whether the buyback represents good use of capital. The tax treatment of dividends plays a crucial role in shaping both corporate dividend policies and investor preferences. In many jurisdictions, dividends are taxed differently than capital gains, creating complex considerations for both companies and shareholders. For companies, dividends are typically not tax-deductible, unlike interest payments on debt. This tax disadvantage of dividends compared to debt financing is one factor that companies must weigh in their capital structure decisions. For individual investors, the tax implications of dividends versus capital gains can significantly impact their after-tax returns. In some cases, investors may prefer companies that reinvest earnings or conduct share buybacks rather than pay dividends, as this allows them to defer taxes until they sell their shares. However, tax laws vary widely across countries and can change over time, adding another layer of complexity to dividend policy decisions. Companies must stay attuned to these tax considerations while also balancing other factors in their dividend strategies. Dividend policies can vary significantly across different countries and regions, reflecting diverse cultural, economic, and regulatory environments. In some markets, such as the United States, there's often pressure for companies to pay regular dividends. In others, Such as many emerging markets, retained earnings for growth may be more emphasized. These global differences extend to payout ratios, dividend frequencies, and the balance between dividends and share buybacks. For multinational corporations, navigating these varied expectations adds another layer of complexity to dividend policy decisions. Moreover, global economic trends and currency fluctuations can impact dividend policies, particularly for companies operating across multiple countries. A strong home currency, for instance, might make it more challenging for a company to maintain its dividend payments to international shareholders. Understanding these global perspectives is crucial for investors and companies alike in an increasingly interconnected financial world. It underscores the importance of considering dividend policies within their specific market contexts rather than applying a one-size-fits-all approach. Trends likely to shape dividend policies include ESG investing, technological disruption, an aging population, and the debate on corporations' role in society. Companies must carefully balance dividend payments with sustainable practices, innovation, and shareholder expectations in an evolving business landscape.